The real-time real estate segment today being brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrmoney.com, rsrmoney.com. Let's take a look and see what we're going to chat about today in the segment, how inflation affects mortgage rates. When you read about the housing market in the news, you might see something about recent decision made by the Federal Reserve. Yes, and you know my feelings about the Federal Reserve.
Such an idiot.
Yeah. But how does this decision affect you and your plans to buy a home? Here's what you need to know. The Fed is trying hard to reduce inflation. And even though there's been 12 straight months where inflation has cooled, and if you're watching us on RonSiegelRadio.tv, any of our socials, or the ABC News and Talk AM 1490 video feed, you're actually seeing a chart that shows the inflation continuing to moderate. While you may have been hoping the Fed would stop their hikes since they're making progress on their goal of bringing down inflation, they don't want to stop too soon and risk inflation coming back up as a result. Because of this, the Fed decided to increase the federal funds rate again last week. As Jerome Powell, chairman of the Fed, says, quote, "We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored," unquote. Greg McBride, Senior VP and Chief Financial Analyst at Bankrate, explains how high inflation and a strong economy play into the Fed's recent decision. Quote, "Inflation remains stubbornly high. The economy has been remarkably resilient. The labor market is still robust, but that may be contributing to the stubbornly high inflation. So, Fed has to pump the brakes a bit more," unquote. Even though the Fed fund rate hike by the Fed doesn't directly dictate what happens with mortgage rates, it does have an impact. As a recent article from Fortune says, quote, "The Fed funds rate is an interest rate that banks charge other banks when they lend one another money. When inflation is running high, the Fed will increase rates to increase the cost of borrowing and slow down the economy. When it's too low, they'll lower rates to stimulate the economy and get things moving again," unquote. So how does this affect you? That's the important part. In the simplest sense, when inflation is high, mortgage rates are also high. But if the Fed succeeds in bringing down inflation, it could ultimately lead to lower mortgage rates, making it more affordable for you to buy a home. Another graph that shows that when inflation decreases, mortgage rates typically go down. Take a look at the graph again if you're watching us on any of our socials. As the data shows, inflation is slowly coming down, and based on historical trends, mortgage rates are likely to follow. McBride says this about the future of mortgage rates, quote, "With the backdrop of easing inflation pressures, we should see more consistent declines in mortgage rates as the year progresses, particularly if the economy and labor market slow noticeably. Bottom line, what happens to mortgage rates depends on inflation. If inflation cools down, mortgage rates should go down too." If you want to have a specific conversation about these things, give me a call, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. That is the real-time real estate segment, again, brought to you by rsrmoney.com, rsrmoney.com.